In this chapter, we will review all the analyses we've done so far. These include our liquidity ratios, leverage ratios, profitability ratios, turnover ratios, and investor ratios. In this slide, we'll summarize our analysis of ABC companies' overall liquidity. Our cash ratio is low, 0.3 to 1, with a standard of 0.7 to 1. Our acid test, or quick ratio, is 1.2 to 1 with a standard of 1 to 1, which is good. And finally, our current ratio is 2.33 to 1, with a standard of 2 to 1, again, good. Overall, our liquidity, the ability to meet short-term debt obligations, is good. Now we move on to the leverage ratios. Total liabilities divided by total assets is 1 to 2, with a standard of 2 to 1. This implies there is room for more debt if needed. Debt divided by equity is 1.18 to 1. With a standard of 1 to 1, the ratio is good. Finally, there's times interest earned. That's EBIT, or operating income, divided by interest expense. Our ratio is 5 to 1, even with the standard. If we are going to borrow more, we would need to increase EBIT because interest expense would go up. To summarize, we have an adequate capital structure. That's the relationship of debt to capital. But more borrowing would require higher EBIT. Now we summarize our profitability ratios. The company is experiencing a steep decline in gross margin from the standard of 40% down to 34%. The difference, 6%, represents $56,000, which is more than total profits. Excess accounts receivable has a holding cost of $8,000. Excess inventory has a holding cost of $12,750. Total losses, about $76,750, nearly twice current earnings. With turnover ratios, we saw the same metrics for accounts receivable and inventory, showing excess and the related holding costs. That's $8,000 for excess receivables and $12,750 for excess inventory. We also saw that accounts payable was close to normal. Net profit to total assets was low, 5.4% actual versus 8% budgeted. In general, turnover of accounts receivable, inventory, and total assets was subpar by the amounts shown in previous slides. In the investor section of the ratios, earnings per share was $3.50. The stock was selling for 12 times earnings. The dividend payout was normal at 40%. The dividend yield, based on a stock price of $45, was 3.33%. That's considered low unless we're seeing dividend growth. Earnings potential, $56,000 in gross margin improvements, $8,000 from better accounts receivable, and $12,750 from better inventory turnover, for a total upside of $76,750. The company is selling for 2 times book value. Book value is $275,000. Market value is $450,000. The stock will not be worth more unless management improves gross margin and tackles the challenge of excess accounts receivable and excess inventory. What an amazing journey. In just a few hours, we have learned how to analyze financial statements like a pro. We learned all about the 3 financial statements. We learned the difference between cash basis versus accrual accounting. And the journey continues with 5 additional video series. 1, managerial accounting. 2, how to raise profits and enterprise value of a business. 3, Rothschild's secret, a formula for wealth creation. 4, tax savings available to U.S. real estate investors. And 5, huge tax breaks for American business, USA only. All video series. Downloadable from our website. What is available to you, the viewer, is a body of work that took over a year to develop, drawing on over 40 years of consulting experience. It was a significant investment, but part of our mission to increase financial literacy around the world and for our clients in the USA. This offering is a labor of love, and we hope you benefit greatly from it. Thanks for joining us on this journey of new knowledge.